All right, today we're diving into Ardmore Shipping's latest earnings call. And this one's a bit of a head scratcher. On paper, it looks like a home run. They beat expectations. But then you look at the stock, and nothing. It barely moved. So what's the real story here? Let's dig in and figure it out.
So yeah, that's the big question, right? Ardmore comes out with these numbers that should have Wall Street cheering, but the market just shrugged. It makes you wonder, what did the big investors see that the rest of us missed? We're going to unpack everything, the results, what management's planning, and maybe most importantly, the macro trends that are pushing this whole market around.
Okay, let's get right into it. First things first, let's just look at the numbers. And honestly, by pretty much any metric, this was a really solid quarter for Ardmore. So the big headline number everyone looks for, earnings per share. They came in at 22 cents. Now, the consensus on the street was for about 18 cents. So that's not just a beat, that's a clear beat. You think that would get people excited, right? Well, not so much. I mean, sure, it popped a little bit in the pre-market, almost 3%, but by the time the closing bell rang, it had fizzled out to just over a 1% gain. That is a very lukewarm, kind of meh reaction for a company that just smoked expectations. It really makes you ask, what else is going on under the hood? Okay, let's dig a little deeper, because this is where that disconnect really starts to stand out. Take revenue. They didn't just beat, they absolutely crushed it. $72 million against a consensus of around $46 million. That's huge. And maybe even more telling, look at the guidance for Q3. They're already booking ships at higher rates than they got in Q2. That's a sign of some serious momentum, which just makes that flat stock price all the more confusing. So while the market was kind of scratching its head, you know who wasn't? Ardmore's management. They were busy. They made some really aggressive, smart moves this quarter to set the company up for the long run. It was basically a three-pronged attack. First, they went on offense, expanding the fleet. They snapped up 3 modern tankers to boost their earning power down the road. Second, they shored up the finances, refinancing their debt with a brand new credit facility, at really great terms, by the way. And third, they played it smart. They secured some time charters, which basically means they locked in some guaranteed revenue to act as a safety net. It's like they're playing offense and defense at the same time. Really solid stuff. And here's a little detail from the call that I thought was particularly brilliant. It's about their operational upgrades. Ardmore has been recoding their chemical tankers with these super high-spec materials. And the president, Bart Kelleher, put it perfectly. He said they're practically behaving close to stainless steel tankers, but at a lower capital cost. Think about that. They get the ability to carry premium cargo, like a much more expensive ship, but without paying the premium price. It's just a super smart way to squeeze out more margin. So if Ardmore's own numbers are solid, and their strategy seems really on point, maybe the story here isn't just about Ardmore. Maybe it's about the entire market they're in. And you know, management spent a lot of time on the call, making a very, very bullish case for the whole product tanker industry. The first big piece of this puzzle is all about supply, or really, the lack of it. The global fleet of these MR tankers, it's old, like the oldest it's been in over 20 years. At the exact same time, the number of new ships being built is at a historic low, only about 14% of the current fleet. So you've got this wave of old ships about to hit the scrapyard, and barely any new ones coming to replace them. I mean, that is the textbook definition of a supply squeeze. Okay, so that's supply. What about demand? The key phrase you need to know here is ton-mile growth. It sounds complicated, but it's not. All it means is that stuff is traveling farther. Think about it. Old refineries are shutting down in places like Europe and the US, while these huge brand new ones are popping up in Asia and the Middle East. So the gasoline for your car, the diesel for trucks, it now has to travel way, way farther to get to the pump. These longer voyages soak up tanker capacity, driving up demand even if the world isn't actually using more fuel. And it's not just that. There are a bunch of other things pushing rates up too. You've got geopolitical chaos forcing ships to take the long way around. You've got Europe, which is running low on diesel and needs to import more. Then you have new export quotas coming out of China and OPEC Plus promising to pump more oil, all of which means more product that needs to be shipped. You add it all up, and it is just a powerful cocktail of tailwinds for this entire industry. Okay, let's bring it all together. So we've got a company that beat earnings, is making all the right moves, and is swimming in a market with some incredibly strong fundamentals. The million-dollar question is, what do you do with that? Let's try to think about this like a pro, like someone on a trading desk.
So how would a hedge fund trade this?
If you were an analyst and you had to walk into your portfolio manager's office with an idea, how would you structure it? Because it's not enough to just say, I'm bullish. You have to have a specific, actionable idea. So here's one possible way to play it. It's a tactical trade, and it's actually two bets rolled into one. The first bet, on something like the BWET ETF, is basically saying you think the broader tanker market might see its volatility calm down a bit. You're collecting some income there. But the second bet is the real core of the idea. It's a targeted, long bet on Ardmore specifically, using a call spread. This says, I believe Ardmore, because of its fleet growth and operational smarts, is going to outperform its peers. By putting these two trades together, you're isolating your bet on Ardmore's unique strengths while hedging out some of the broader market noise. So what's the final verdict? Our rating for Ardmore is outperform. When you look at the strong execution, the proactive strategy they're deploying, and those powerful macro tailwinds, the whole picture looks incredibly compelling. Way more compelling, I think, than the market's sleepy reaction would have you believe. This company just seems perfectly positioned to take advantage of what's shaping up to be a very strong market. And, of course, we have to say it, this is not financial advice. Everything we've talked about today is for informational purposes only. You have to do your own research before making any kind of investment decision. Thanks for tuning in.